Welcome.
How is everybody doing? Look at all of you. It is, Jennifer, I cannot believe that it is December 2021. Where has the time gone? Like, it has been crazy this year.
I have no idea.
And I'm just so impressed at the number of people that I meet who made difficult choices and created stuff in the middle of a 2-year pandemic. So, phenomenal. Well, welcome everybody to our Real Estate Wealth Lab meeting. So excited to have you here. Jennifer Hunt and I will be your co-host. I will be your co-host. Jennifer is really the leading edge of the sword today. And for those of you who don't know Jennifer, if you are brand new to our little family here, you need to know that Jennifer comes to us with a ton of experience. She has under her belt over $25 million in real estate projects. She's been investing in real estate for over 20 years, and it's not real estate investing in a certain city or a province or a nation. It is all of North America. I know that she is into multifamily, into vacation properties, into single homes, all kinds of things. All of us here at REWL, we are dedicated to helping you become, go to the next level and become really good at what you do and really be able to invest in real estate wisely so that you can create a different future. Now, as we go through our evening today, a couple things that I need to get off the table, so to speak. One is our legal disclaimer. You need to know that the information we provide, it is forward-facing information, but before you take a step and invest money, you are responsible to do your own due diligence and to make sure that you connect with the right professionals. So you can take a screenshot of that if you want, but you can read that at all the details are there. It's kind of boring stuff, but we've got to put it out there. Next, a couple rules for our evening today. One, we want you to be involved. So do ask questions, do say hi to in the chat, do engage with us. And if you have any feedback, we are a young company. Although we have years and years of wisdom accumulated underneath us, we are a young company. And as a young company, we so appreciate your feedback. Engage with us. Tell us what's working for you, what's not working for you. In fact, if you could even at the end of our meeting, tell us one thing that you liked, that you would have liked to hear more of, or one thing that you didn't like, that you would like to hear less of. Be respectful and courteous, but please, I don't think I'm looking through the room here. I don't think I need to share this with it, but just don't solicit, don't try and sell stuff, behind the scenes. It's just being nice. This event is being recorded, so if you are registered as a REWL member or as a guest, you will be getting a copy of the event. Now, we are going to jump right ahead because, Jennifer, I believe you've got a lot of stuff packed in here today, have you not?
I really do. Well, we wanted to end 2021 with a bang, and we're really responding to what our members have asked for. And so we're diving deep into US markets, of course, looking at Canada as well in terms of what's going on macro, but you got it. So take us away.
Jennifer, one thing I want to interject here, and one thing I want us to notice is that I don't know of any other group of real estate intellectual wisdom creators that actually look at not just a city or a province, but actually look at entire North America, Canada and the US. Very few people do. In fact, I don't know of anyone else. So I'm so excited to be partnered up with you on this.
100%, Niran, and thank you. This is definitely next level for REWL because we're broadening our horizons. We're global investors, and we understand the benefits of diversifying our portfolios, our currencies, our politics, our geography, and you name it.
Jennifer, hold on a minute. I'm just looking here. 8:45 to 9:15 market analysis. Florida, Miami, Fort Lauderdale, Orlando.
Yeah.
Like,
I know, buckle up. I don't know. We're doing 3
Buckle
cities
up.
today.
Get an extra pen. Awesome. Yeah. For our new members, you know, it's the end of the year and I keep meeting all the time. Like, I don't know about you, Jennifer, but at the end of the year, our minds start shifting towards, hey, what have we done this year? What's coming up next year? In fact, you know what I'd love to hear in the chat? Often when we go from one year to the next year, we're always looking forward to what we want to do in the next year, but we don't stop to see what we actually did this year. In the chat, what are you throwing? What city you're from? And one thing that you are really proud of that you accomplished or did in 2021. Throw it in the chat for me.
That's
Where
so
are you
cool.
from? Because we do not take stock of what we have done.
And, you know, I'm seeing Catherine tuning in from Mexico. That was a big deal. I know we talked about your portfolio, Catherine, and so congratulations for that big move. That was awesome. And Dawn is in snowing Regina. I'm so sorry, Dawn, but we so are blessed to have you here. Julia's from New York. Look at this. I said we were global. Did I not, Niran?
We were.
Right on. Vincent, Edmonton, Corinne, Miami. Congratulations, 2 rental properties this month. No, Corinne, were those in Miami? Erica, Toronto. Yeah, Toronto. Corinne, no. Okay, cool. Kitchener, awesome. Ontario, and started portfolio in Jacksonville. I think I've got something in today's I know I have something in today's newsletter about Jacksonville, but I can't remember if it's in this slide for today, but some interesting stats going on there. So congrats. Langley, Toronto. Shannon, hi Shannon. Shannon came on a sailing trip with me in the British Virgin Islands, and that's how we got to know each other.
So for people who don't know, Jennifer loves to sail, and her nickname is Huntress because she is amazing at hunting down not just real estate stuff, but really fun things to do. If you follow her on social media, you'll figure that out pretty quick. Hey, Jennifer, I want to pause for a minute and really welcome our new members. This month, new members, 41. That's just amazing. I'm so excited that you're all here, and I believe that not all our new members are represented on this slide because in the last few days or last week, we've had more people join. Is that right, Paige? I see you nodding your head. Paige is responsible for our customer experience. So yes, so if you are a new member, welcome, buckle up. It's going to be a lot of fun. Now, what is REWL? Well, Jennifer, I think no better person than you can explain. You can explain this really well.
All right. Well, thank you, Niran. And you know, again, a huge, great sense of gratitude to everyone who has joined us so far and getting ready for the new year. So what is REWL? REWL is a real estate wealth lab, which is a lab that's dedicated to your research needs, your calculation needs, your analysis, and everything that you need in real estate to take your portfolio to the next level. And so while today we are at our research lab, we're going to go through some of the other components that we have that are available to you and that we're working on in the background, including combining artificial intelligence, real estate investment, leadership, as well as proprietary formulas and all this analysis in the background that allows us to take that guesswork and uncertainty out completely so that you get personalized, and this is where it's really different too, personalized investment intelligence based on where you are today and where you want to go and what you've got in your portfolio. And this is just some of the leaders in REWL that are working behind the scenes and in front of the scenes to support that. So I'd like everyone, if they're on here, to give a wave if they can. So yeah, Niran's here, our Chief Leadership Officer, which is awesome. Vincent, I know he's on. So Vincent is our Chief Technology Officer. Yan, whoop, all right, yeah, our Chief Marketing Officer. We have Paige, our Head of Customer Service Experience, I should say. So that's awesome, thank you, Paige. And Ken, our Chief Operating Officer. Right on. And this, guys, and ladies, guys, I'm sorry if that was too colloquial, but these are just the beginning and some of the amazing people who are all next level investors wanting to support and create something for next level investors. And each one of these has their own team behind them that are bringing even more research and intelligence and even more leadership and even more technology solutions and even bigger marketing ideas that we can use as real estate investors, by the way, and even more customer service and more operating, which is some of the things that we'll talk about today. So without further ado, welcome team, that's awesome. And I'll carry on. I do want to acknowledge that many of you have been with us since the beginning. We've actually offered a free trial since September. So thank you for being here. I do want to acknowledge you as we mentioned, but I also want to say, hey, we're going to do just a very brief introduction to what REWL is. So where I apologize if you've heard it before, but it's really important for those who have not yet, because there is only 9 days left of our open house free trial. So please get in there, check it out because it's free. And you may find some interesting things that will help support you, including some of our events. Well, today is our last free event, our last research lab, free research lab, I should say, of 2021, but lots more to come next year. So why joining REWL is the benefit is because you get automatically registered at all of our events and you receive our weekly real estate intelligence newsletter. Also, you get access to our members portal and the whole service team. So there is a lot going on behind the scenes. And for those of you who joined our community lab last week, got a taste, an exploration of the calculators, there's access to all of the slides and the data. For example, I've got a lot of data in here for you today, and I'm not expecting it all to be absorbed, but it's available to you so that you can go in and go, you know what, I want to use this data piece and put it into my own PowerPoint for my own clients. You can do that. It's yours. And access to all the calculators. So I'll talk through those in a moment. This is a little bit about what the intelligence newsletter looks like. And we look at different things. We look at different data. We look at different indicators and how they impact your real estate. And every single newsletter has what it means. Every single article or study or survey has what it means to you as a real estate investor. And sometimes it's pretty funny what it means because we're learning there's so much to learn out there right now, especially with headlines that are kind of crazy. So we unpack that for you so you don't have to. And some of our products in our portal, these are what some of our calculations are: fast filter, mortgage loan calculators, Airbnb, house value, selling your property, deal dicer. It goes on. And right into these: deal analyzer, deal fractionalizer, portfolio diagnostic calculator. See, there's a lot. Now, why calculators and why care? What's cool about the way we've designed these is that for some of you, you know that I love spreadsheets, and as property owners, we like to do analysis and make sure that we're getting the best deal. These allow us to be mobile, super friendly, not getting lost in the weeds of a formula in a spreadsheet. These are really, really valuable tools. And here's some save the dates for, well, next year. So 2022, January 12th, January 19th, and January 26th. What I'd love for you to just remember and pop it in your calendars is that we have 3 events a month on the 2nd, the 3rd, let's try that again, on the 2nd, the 3rd, and the 4th Wednesday of the month. So we've got our Market Leaders Lab, followed by our Community Lab, which is more integrative and working sessions, if you will, and hands-on. And then Research Lab, of course, is where we have our macro and micro analysis per market. So our next event is January 12th, and we have a very special event that day. We have a special guest, David Falk. And for those of you who don't know who David Falk is, you're in for a real treat. He is listed as one of the 100 most powerful people in sports. You might be wondering, why? So like, why a sports guy in real estate at our REWL event? Because he is an amazing real estate investor and marketer, and we get to tie all of that together. Oh, and more, of course, and we get to tie all of that together, which is awesome. And it will actually have him interviewed by, I'm bringing on another special guest, Richard Dolan, and myself, and we'll be interviewing David Falk. So it's January 12th, and find out why this sports superstar is a real estate investor as well, and how he does it. And please follow us on Instagram, Real Estate Wealth Lab. We are producing some really cool videos and content about what we're up to, but also even updates about the market. So you'll get some interesting tidbits about the market if you miss them here, and also that you won't get here. So you'll definitely want to check us out. And of course, if you have any questions at any time or want to understand more about your experience with us or what's available to you, please contact us, info@realestatelab.com. All righty. Well, are you guys ready to buckle up? Because we're into it. And I see, okay, I'm going to go for it. Is that all right, Niran?
That's perfect, Jennifer. Let's jump right into it.
Okay. All right. Well, ladies and gentlemen, before I go here, I do want to make a special recognition for all of you. It's December 22nd. Christmas is like 3 days away, and you're like hundreds of people here taking your time out of your valuable day, your valuable time, and spending it with us right before the holidays. So we're so grateful for you. So thank you again. And it makes this way more fun. So be prepared for some gifts. Today, there's a lot of gifts. Not gifts.
Jennifer, if I can interject something here, not only are we privileged to have you join us on the 22nd of December, but just pause for a minute and think of the room that you're in. We're doing this by Zoom. If we were in an actual event place, the people that you have chosen to surround yourself with, you're all a little crazy. You're showing up to learn about real estate on December 22nd. You are in a room with the movers and shakers of 2022, right here. So, good for you.
Well said, Niran. Well said. Thank you, everyone. Okay, all right. So we're going to be talking about real estate cycles and the real estate cycle formula. But what it means, a real estate cycle, is simply the business cycle of real estate. We're always grounding ourselves in here. Are we in an expansionary phase where prices are going up, or contraction, or a stabilization phase? And you'll see where we are just in a moment. And then we apply the real estate cycle formula. This is truly incredible. What we've done is we've started to take these leading indicators, which, by the way, some of these leading indicators are not seen in anybody's analysis anywhere. That's why it's proprietary, and we're still working on copyright, so I'm not showing you all that, but in the background, there's some pretty cool stuff. And what we're able to do is, for the first time ever, is monitor how they impact and their weighted impact, because it's not just smooth sailing and it's not just going down. There's different population. We're going to talk a lot about population and how it's impacting even more than economy ever before. Very fascinating stuff, and you're going to see that particularly when we get to the Florida market analysis. In addition, our real estate cycle formula can actually help forecast with way more accuracy than ever before the duration of a cycle. So here we go. Let's look at the data and where we are today, because all of these things are changing all the time. So we're also, because we're North American, we look at Canada and the US data. So you'll see we bounce back and forth between the two. We start with GDP, that's economic health. So what's going on? Stats Canada, gross domestic product by industry. So they produced the report at the end of November, and real GDP, the big conclusion was real GDP is up 0.1% in September. Okay, I'll get to that in a second. So that was due to declines in manufacturing, construction, and retail trade, and that's offset by expansion in service industries, mining, and oil and gas. Yeah, I'm being a little bit sarcastic. Cool story, bro. Like, let's tell it again. We're up 0.1% and 0.8% growth is what was showing. Now, that's not great. So it's also super low growth rates. It's old data also. And then since then, the new COVID-19 pandemic related variant, Omicron, I'm just going to call it C19O, threatens the world with another cycle of lockdown. So we don't know how that's going to fully impact our economic recovery. So even these very small recovery and small growth, they're not really a good story for us, because it's hard to understand what's going to happen. What we do know is that economic recovery is in forward motion. We're in an expansionary phase, but it's at a snail's pace and it's not at pre-pandemic levels yet for the majority, for the most locations. So what it means for you as a real estate investor is it means that rents and property values are following suit, sorta. And this is where we're going to get into some of those other leading indicators like population and like jobs that are doing weird things that are having a cool effect on actually propelling us a little bit further along into that expansionary phase. So it ain't all about GDP, although that's quite important. So in the provinces, just to bring that down, is that they are expected to enter advanced stages of recovery in 2022. All provinces in Canada are expected to grow in 2022, but the pace of growth is going to be slower. And we're going to talk about that a couple of times tonight because there's a little bit of deceiving information out there of how it kind of registers in our brain. There is growth. The growth is slower. So they're downgrading their forecasts. And this is another little cool way of looking at things is Saskatchewan, Alberta, and Ontario. You're going to see headlines that are going to lead growth. Awesome. But it's because they have more ground to cover. And so we always have to look at it like, yeah, they're leading growth, but actually it's because they were further behind than the rest of the provinces. So I hope that really lands with you of how we try to unpack headlines and stories so that they make far more sense to us as real investors. And then we're talking about inflation and supply chain disruptions and labor markets, and all of that's going to challenge all of the provinces and all of the economies really everywhere. And more to come on that later on in the presentation. Here's some data for you that you may find valuable. What you're looking for always is if your state or your province has a growth rate that's higher than the national average. That's really what you ideally want. So very interesting here. Saskatchewan, which was further behind, has a high growth rate. And so that's bringing up Canada. So most of the other provinces are being below the national average. However, while that's a good metric, you still want to be where they're growing well, but they didn't have as far to go. So we need to find that net, what we look at is net GDP. And we get into that when we get into the deeper market analysis. We provide the net GDP of like what's actually going on here. What's the gap? Are they growing or not? So in the US, what Wall Street economists expect for the US economy in 2022? I loved this article because it was way more than this. There's just like a ton of different like Wall Street economists, like just listing them all. And it was such a wide range. So Goldman Sachs said GDP is going to be up 3.8%. Bank of America, GDP up 4%. Wells Fargo, GDP up 4.1%, and then slowing down to 3.3%. But remember, that's still up, so that's good. So that's cool. You know, like they're all well within a range. So this is good information. But I really want us to ground ourselves for a second. I had the privilege of having a very cool conversation in person years ago with the chief economist at the Alberta Treasury Branch, ATB. And one of the things that he said was, we make forecasts so that we can revise the forecasts. And what that means is there's always new information coming. There's always new politics, new policies, new whatever that we have to then factor in. So when we say we are forecasting something, it's just good to know that that's a forecast. It will change like 100%, but we want it to change so that you know that it's being more accurate and it's being revised when more information becomes available. So I think that's kind of cool. And that's what we do here also at the Real Estate Wealth Lab. Economic recovery is set to grow steadily, slowly, modestly, if you will, and resume a more normalized growth pace in the next year. Remember, growth pace, it's going to still be growing, but so don't let those headlines go, oh my gosh, it's going to be 2% growth. That's okay. Once we get over that pre-pandemic hump and get back to a normalized level of economic output, we can have those sort of slower growth. And guess what? Slower economic growth is actually not a bad thing. I know you're going to think I'm crazy. You want it to be actually not super, super high because that means that it's unstable. You want a sustainable, like a good 3%. 3% is good, like really good. 4% starting to get into that higher side. I'm giving you benchmarks here. 2% is like freaking right on there. That's for Canada. Not all countries are created equal. All right, so for investors, this is again expecting that modest economic expansion, which is great for long-term buy and hold in real estate. You really can't ask for anything more. Slow, steady wins the race. Now, if you want other tactics like fix and flip and things like this, then you're going to be looking for different indicators, and you'll look for markets that have more fluctuations based on your model. So we will see that rents property, but on the buy and hold side, rents property values typically are going to follow suit with this nice, slow economic recovery. And this is considered a buy signal. So this little, I love this little article or the cartoon here. By the way, there's been another revision to our estimates. Exactly. That's how it works. That's normal. So it's okay. But when we plot this on our real estate cycle formula, you can see that GDP is just really, really flat. Like when you start looking at the net GDP, the net economic output from where we were to where we need to get to, it's actually like not quite where we need it to still. But because the numbers are growing and not going down, we're kind of calling it about flat. When it comes to jobs, Canada has now over 1 million vacant jobs as more people are exiting the workforce. So you're going to be hearing, I'll get there. Just you wait. So job vacancies are up. There's 1 million vacant jobs in September in Canada, and that's an increase of 16% from the month before, from August. So 143,000 more vacant jobs in 1 month. That's actually a third of the population of Toronto is employed population. So it's pretty significant. Now, what it means is that we've got a rise in unfilled, when you think like normally, under normal circumstances, when you see that there's all these vacant jobs, that usually is an indication that the economy is expanding, that businesses are opening, and they're opening so fast that they haven't been able to fill those jobs. That's usually what it means, but not in this case. It doesn't mean that here. We've got something else going on. We've got the pandemic affecting a lot of things. Sorry, I'm going to restate that. We have the government restrictions based on what's happening with the pandemic that are affecting a lot of things. And that means that we've got wage growth that's tepid in Canada. We've got a drop in employment right now because people are actually saying, you know what, they're not on the payroll. There has been stimulus checks, of course, but also people are saying, you know what, I'm going to start my own business. I'm not going to go into this job. So they're not even getting counted. When many of you have heard me speak about employment stats before, and we always look at a minimum of 4. So this is not the full picture of 4 indicators just within jobs. And this is even more important right now, especially as this data, these vacancies are not accounting for the great resignation, including the forced resignations for those who are unable or who have chosen not to have the COVID-19 vaccination. That's just truth. That's not politics. They need to be accounted for. In addition, we've got massive retirements. We've got the baby boomers. Whew, this is happening. So there's a lot of nuances that are really coming into these vacancies. So the job situation isn't rosy. Again, this just means longer, slower, more modest economic growth, making some ceteris paribus with all things being equal at the moment. So stay tuned for revised forecasts for sure. So in the US, the new gold rush. So here's the top 10 cities that job seekers are now flocking to. And you've heard us talk about the Great Resignation and the Great Migration, both in Canada and in the US. Lots happening. Here's the top 10 towns for cities, top 10 cities that job seekers are going to. There are more that are coming up on the list as well. So it's fun because this is only just the jobs. When you start layering in affordability, when you start layering in virtual property buying, like I'm not kidding, we're actually looking at technology and who's buying. The team doesn't know that yet, but we're looking at who's buying virtually and where and how that's impacting where we want to invest our dollars. So like I said, we look at weird data, and LinkedIn provided some amazing data, because in unusual times, you have to look at unusual data in order to get ahead of the trends. So we've heard about the Great Resignation, but in fact, according to LinkedIn data, I'll define the Great Resignation just in case, is where, whether burned out or fed up or just experiencing serious pandemic wanderlust, they've decided to call it quits. There's all kinds of things, but we are experiencing the largest numbers of resignations in history. Okay, so people are quitting their jobs, notwithstanding all the other information that I just shared with you. But there's now, what LinkedIn is showing is that it's actually more of a great reshuffle. People are quitting, but they're moving and taking on new jobs in more affordable locations. Look at this list, more affordable. That's what this list is representing. And in a little while, when we get into the Florida market analysis, I think you're going to see how other factors are also shaping that as well. So these cities are exactly what we expected and what we're looking at as part of our market analysis in 2022. So stick with us, because we've already been predicting these and forecasting for the large part where people are moving to, which is very, very cool. All right, so the lying flat movement. What? Why am I talking about China and lying flat movement? You may wonder that, and I get it, and I appreciate the question. And this is a very important demographic movement that is impacting jobs globally. Remember, the Real Estate Wealth Lab is global. So we look everywhere because of how it affects, and trends do happen across the ponds and even within our various countries. So the lying flat movement is essentially where China as a whole decided that they wanted to end their reliance on imported technology and focus on domestic consumption. What they needed in order to do that is they needed to up and increase their workforce even more. So what that means, and their output. So that means for them that they needed more productivity, they needed more employees, longer hours, you name it. And what's happened is that lying flat movement jump-started. It came up in April, and it's gone viral. And it's a renunciation and a refusal to bear hardships. What does that mean? It means that there's a demographic behavioral change that is very significant and influencing a lot of individuals to opt out of corporate life. Now you may wonder, this is in China. This is where the crux of technology is built, and you name it. There's so much going on there. And if it can happen in China, where folks are just saying, you know what? And granted, this is by and large millennials and Gen Zs, whatever, and millennials as I call them. That's largely what we're seeing. But if it can happen there, it can happen anywhere. So okay, let's look into that trend. So for real estate investors, there is going to be a reshaping of job markets. There's going to be a reshaping of economic activity, of values, and of life preferences. And that includes housing types. So if you have not heard of co-living multifamily yet, please start looking at it. We've actually had one of our first developments be approved, I believe, in Canada, in British Columbia. It's already taking off in the US. And the way I describe it is co-living. Think about like Golden Girls meets Melrose Place, and you get a shared kitchen and shared all this stuff, that you get to have community and save costs and all of this, and have dinners together and play board games and all these things. And so that means that your footprint, your actual footprint of your home, can be a lot smaller, kind of like a dorm in some ways. And this is a trend that's taking off. So let's look at Canada and the US. As I mentioned, those kinds of housing projects, I shouldn't say that, types, because they're development projects, but they're housing types. So what we're seeing is from the Great Resignation to lying flat, workers are opting out. This is the same thing, lying flat in China, Great Resignation in the US and Canada. And we've gone through the numbers already in terms of people are quitting for all the various reasons that I've mentioned, including more of them, but also that burnout and deterioration of mental health. And hey, philosophically, maybe I don't align with this corporate thing anymore. And so this is impacting our economies, our job markets, and real estate. So again, we're seeing this urge for community. We're seeing an urge for cheaper and different types of real estate. And we're seeing just a complete change in our renters and buyers' wants, needs, demands, and prices. Again, coming back to that rise of co-living. So why is this happening? And I like this quote from this article. It's very good, long article, but here I am summarizing it for you, so you don't have to read it. And one of the quotes that really stuck with me is, the crux of this query, I believe, is in the face of existential threats, such as the pandemic and climate change, the Great Resignation and lie flat had the potential to spark a deeper discussion about the relentless pursuit of wealth at the individual level and for nations as a whole. So I'm only bringing this to your attention. No, things aren't going to change wholesale right away, but there is some significant demographic, philosophical movements that are underway that we need to be mindful of, because like I said, they do impact our real estate. So that's where jobs are for both Canada and the US. They're kind of down. We're not seeing a huge upward trend. So this means, again, what this does is it elongates the real estate cycle. It means the duration is going to last longer. And at the moment, it's still the forecasting models are showing still about a 10-year expansionary phase. Very modest expansion, but we are thinking in decades right now, with some little blips and things in the middle that I gotcha. Wait, it's up next, actually, I think. So people, let's talk about people. So Stats Canada, change in fertility intentions in response to an existential threat, the pandemic, financial security, all of these things impact people's choices to have babies. So most individuals abandon having a child in COVID-19. Some found interest, and the majority are delaying or abandoning. So let's get into stats. So baby making data, due to the COVID-19 pandemic, 24% changed fertility plans. 24%. 19% want fewer kids or to make a baby later. And 4% want more kids. And that's because, there's some benefits to, hey, I'm at home, or I've got more time, or, more care with your partner, whatever have you. But that's a fairly big difference of 24% changed, 19 said no or later, 4 want more. And again, that why, existential threat, stress, job loss, financial uncertainty, these all just kind of make you not want to have a baby, because you want to understand what's going to go into, not you, pardon me, one. And at least for 24% of people, it made them think, is it now? Maybe later. Let's see how this turns out. But who cares? So babies aren't buying houses. They're not your target market. You're not renting from them. I get it. What it does is it reinforces Canada's long-term population requirements that make it more dependent on immigration, because Canada and the US have very low fertility rates. We are talking, so US is a similar story. But what we see is that if we're going to be more reliant on immigration, the government is going to open up that and get even higher targets. Immigrants impact rental and property markets very differently than babies who are born in Canada. It takes longer. It's obviously a baby coming into the market, it might be a 24-year cycle. Whereas an immigrant coming to Canada, the average is about about 77% of immigrants buy a home within the first 3 years of being in Canada, and they've arrived with their down payment. That's demand, and that's demand fast. It's kind of like opening up a fire hose and going, okay, this is coming into Canada in terms of the demand on our properties. So that's fantastic for us as rental housing providers. It really is, no problem. We like that. That's fantastic. We just need to be mindful of how those trends impact and have different lagging times. They have, which I've just kind of qualified, but there's so much more to unpack on that, and we will. We got you covered 100%. So Canada's immigration boost could fuel a hot housing market. Yes, exactly. And also a hot rental market when they arrive, because they rent for the first 3 years, 77% of them. So that's a pretty good typical experience. So the central bank is warning of a sudden influx of investors. We're on track to reach our 400,000 of new permanent residents this year. I gotta say, I'm not really convinced that that's the truth. So we're gonna just see the stats later. Some of those individuals are already here in Canada and it's changing their status. So it's not necessarily that more individuals are coming in at the moment. They're just having their papers changed over, which is awesome. That's fantastic. But it's something to be mindful of, that these stats might not be all that they meets the eye, but they are. And next year we're expecting to try and get those high numbers again of 400,000. But they're targeting, Canada's immigration policies are targeting high-skilled immigrants who bring money and earn enough to compete for desirable housing. So these are important trends. And what I said earlier was that GDP is important, but population, we've got to measure that tracker, because it's leading indicator that's actually surpassing the impact of economics and of jobs right now. Wow. Yep, you heard that here first. All right. So immigration boosts economic activity. Canada's economic output needs immigration because our economic output is not where it needs to be. And immigrants, as I mentioned, tend to demand anyway, or demand housing of all kinds, and that typically raises rents and property values. So what we see in this little, it's kind of a mini Venn diagram-ish, but where you see immigration in the middle, there's economic activity, housing, demand, those occur, and then that pushes rent increases, that pushes property values. So we need to keep that in mind, but then I want you to consider and lay over top of that. You may recall, although I know I say a lot of things during these events, but we have in Canada and in the US, we have a serious lack of housing, and we don't have enough supply, and we must build. And I've got some stats on that in just, I think, a moment, so I won't spend too much time there. So as you can see, population, it's not a huge up, but it is going up, and we're expecting immigration to play a good part of that. But when we look at our market analysis, outside of just the national macro analysis, that's where we get into these concepts of the Great Migration and whatnot, that we'll get into a little bit later when we talk about Florida today. So inflation, you know, this is really important, and it's something that we're very proud of at the Real Estate Wealth Lab, because many individuals, if they consider inflation in their real estate cycle, they consider it as a lagging indicator. However, I've got this thing, you know, 2021 has been a theme for me. I should have put that in here, of like chicken or egg. So inflation can be a lagging indicator, but it can also be a leading indicator based on what we're looking at. And when it comes to housing, inflation is a leading indicator. Chicken or egg? We got you covered. All right, so moving along to inflation, and why I keep harping on it is, before I get into it, US and Canada, monetary rule, I highlighted rule, drives inflation surge. What the heck does that even mean? What it means is that in Canada, there's going to be a new Bank of Canada 5-year mandate. It's coming soon. It's about to be announced. Why this matters is because in both Canada and the central banks around the world, one of their primary mandates is to really only preserve the value of the currency. That's their primary. That means basically managing inflation. That's their job. Maybe a couple other little things, but that's it. Like, that's their number one thing. The new mandate, ladies and gentlemen, is to expand the role significantly. And now I have put a public warning, explicit behavior, a little picture here, is because if the actual role of central banks is mandated to control inflation, and that's kind of about it, we need to be really mindful about the possibilities of these new mandates. Central banks, the Federal Reserve, the Bank of Canada are not elected officials. So some of the mandates that they're considering putting under the Bank of Canada are components that normally a federally elected official, i.e. a member of parliament, would be in charge of, like employment, like economic activity. So this could be a major power shift from an elected body to a non-elected body, and that is a public warning. I don't have the answers. It hasn't come out yet. We're going to be watching this really closely, but you need to be mindful of it. Also, the second thing about this article and what we're looking at is that the central banks, and yes, I mean these globally, truly, but we're Canada and the US seem to have, quote unquote, forgotten about the quantity theory of money. So the quantity theory of money in like very brief terms is that when you print money, it increases prices. It devalues the currency technically, but like, okay, let's get it. So then there's typically a 2-year lag between accelerations in the monetary growth and the emergence of higher inflation. True, absolutely true. 100%. There's a lag time. So when did we start printing that money? Was March 2020. We printed the money and we've been printing it ever since. Like a lot of money for 2 years almost. We've been printing a lot of money. So that causes inflation. It's a lagging indicator when it comes to printing money. But remember, I said it's a leading indicator when it comes to your housing prices. Economics is fun. So at any rate, inflation is rising. Let's wait until March 2022 when it's had that full 2 years. And then because we've been printing money for the last 2 years by then, we're going to be seeing inflation around for quite some time. So we need to be prepared for it. It can be scary. You've heard me say this before. I think I've got it on the next slide or somewhere soon. But yeah, real estate is one of the most stable assets, and it outpaces inflation. So this is the thing to be in when we're in inflationary times. For real estate, exactly. Rents go up with inflation, property prices go up. They should experience a pretty major upward lift through this long expansionary period based on inflation. So these are all buy signals. Warning and a buy signal. There you go. So the pandemic aftershocks overwhelm global supply lines. Now, I love that you folks are here and having this conversation. And on December 22nd, before the holidays, you're spending this time talking about supply chain. Like, this is incredible. I'm so blessed that you're here because this is crazy talk. You guys just want to invest in real estate, but no, you understand that there's all these factors that come into play. And yes, I'm just gonna jump over here. Well, no, it's important. So this is a summary. Is that the cost of shipping a container of goods rose 80% since November 2020. That is massive increase in how to transport goods. Now I've got a little picture of Amazon here because who's been buying more on Amazon since some of the pandemic restrictions have limited our abilities to go into grocery stores or to shop locally or to restaurants. And so that money that one would have taken into the local economy and gone to the restaurants or gone to concerts or gone to a bookstore, or whatever, they've redirected that money to global supply chains. So not only, I think it's on the next slide. So in other words, the demand for global goods has, in a snap, just completely increased. So wait, what? Like I said, transportation costs impact inflation and inflation impacts your real estate. Yes, it does. So it means something to you. Inflation, all of this, with transportation costs going up, it implies inflation devaluing the currency. It implies reduced economic activity. You might be asking why? Well, because the surge in demand and different shipping lanes and shipping lines, they've had to, and I used to be in logistics and transportation for like 15 years. No, gosh, longer. Oh, that makes me old. Shh. So at any rate, I love logistics. I think it's really cool. And it does, like, you get a new route, you got to start figuring it all out. And that has reduced our economic activity as those shifts have changed. It's also reduced our access to certain goods. How many of you, ladies and gentlemen, have had challenges getting appliances? Any of your renovation materials, lumber, we know went up, WD-40, any of those? So with inflation also, we're seeing increased rent and property prices. So the supply chain reduces the amount of goods available for service. That means it's lowering the GDP. And for investors, again, you want to think about the impact of inflation, and this is a buying signal. I want to just highlight 3 economic concepts to explore when one is considering this major sort of global macroeconomic trend, is that we want to look at equilibrium price, the velocity of money, and M2 money supply. And I suspect that that's something that we're not going to do in this research lab, but we may do some extra videos or something to help fill that gap for you, because that's important to know and to have on our radar. So in summary, just because I know that was a lot. So in summary, you can see little Santa is trying to help these boats. In summary, demand shifted to overseas goods, which reduces local GDP. The supply chain couldn't deal. That reduces supply, which reduces GDP. The demand has gone higher and the supply has been no bueno. That's really what you need to know. And this increases prices and it devalues our currency. And it is an inflation exacerbator. That's what transportation, the logistics and supply chain issues. So when you're seeing them in the headlines, you now know, oh, shoot, this is what's going on. So this makes it even more, this is another note. This makes it even more important than ever before to, when you're doing your homework, when you're doing your deeper diligence and market analysis, you want to look at what's going on in that local GDP. That's very important because it's different. The numbers are different now. So the rental market, this is an article from Redfin. They did some great research. Their top market tracker when it comes to rents. They're saying that rents are up 13%, outpaced by 17% growth in monthly mortgage payments. All right, so top areas with the fastest rising rents. Look at this list. West Palm Beach. Oh my gosh, I went there. I went to a polo match in West Palm Beach. That was really fun. And then Fort Lauderdale, Miami, Seattle, Jacksonville, Portland, Austin, Newark, Nassau County, and New York. So we've got a lot of, that's one of the reasons why we've got Florida on our radar, but one of many. So, all right, moving forward here. Okay, so we've got, what all this means is that we're increasing home prices, generally speaking, out there in the market, are forcing more people into the rental market. And pricing many, the increasing home prices are pricing many out of the home ownership dream altogether. People are putting their dreams aside, even though they want them. Putting upward pressure on rental prices, making rental housing more lucrative for investors. Aha, there it is. Making it more lucrative for investors. So we want to be paying attention to this. North America has been and currently continues to be on a trajectory of a nation of renters. North America is on a trajectory of a nation of renters, and it has been for a number of years. What that means is you look at Europe, you look at England, you look at, gosh, all kinds of different locations in Europe, and there's many more renters than there are homeowners. This is a buy signal for those who are next level investors. The real estate market, average home costs are up 30% since before the pandemic. So CMHC links it to speculation. That's what they're saying. The CMHC thinks investors are driving increases. Now, this is the current CMHC because I got something coming up from the former CMHC and it says the exact opposite. So pay attention. Investors are not the main issue. The issue is the lack of supply. We've been saying this since 2015. And in other research organizations, there's been all kinds of details about this since even, oh gosh, I'd say like 2010 maybe. Some really credible stats. So it has been a lack of supply. That's right. Thanks, Ken. So instead of blaming investors, a quintessential blame the other person and that sort of side of things, instead of blaming investors, we need all levels of government to say, okay, we have a housing shortage. Oh, and remember what I said earlier that people stopped having babies by and large during the pandemic, or at least reduced it? That means that we're going to need more immigration. That means there's going to be even more demand on our real estate. And we don't have the labor shortages. There's construction issues, and we don't have the zoning to support it. I mean, this is really, really big stuff. So both the US and Canada are at least 1 decade, an entire 10 years at least, behind on housing supply in order to satisfy current housing demand. That's current demand, a decade. Well, you don't build a house overnight. You don't build tens of thousands of houses or upwards of millions of houses, whatever kind of product, overnight. These are things that take time. And what do you think that this is going to do for real estate prices and rents? Supply, demand, big demand, not enough supply already, more coming in terms of demand. Oh, you got it. Expect upward pressure on both for quite some time. And that's where we're looking at least a decade into the future as well. So Canada, not in the midst of housing bubble, former housing and mortgage head. So remember I said the current one saying, okay, well, investor speculation, that's causing some of the problems. Well, in fact, the former CEO of CMHC says that many factors point to a hot housing market, but it is not accumulating into a bubble. Long expansionary phase. And this is the perfect quote. If demand is going up and supply is not, prices will go up. And that, ladies and gentlemen, is not a bubble. And that is Evan Siddall, the former CEO of CMHC. So I hope you like what we need to do and what we're not. We are not in a housing bubble, and what we need to do is to build supply. And in the US, where the housing market is going in 2022, as told by 7 leading forecast models, Zillow up 13.6, Goldman Sachs 16%, but 13.5 on an annualized basis. And simply put, what we're seeing is that prices are going up through 2022. Now, you're going to see concepts like slower growth, and I mentioned that already, so pay attention to that. We are going to have growth in housing prices, but it will be maybe not as high, although I have a theory about that, and I think it might be a little bit longer on these higher expansionary amounts. So then when it comes to Forbes, experts predict what the housing market will look like in 2022. This was a really cool article. It went through, I think maybe like 50 or something. I mean, it was a huge number of expert organizations, individuals, and all of their predictions. And they ranged, as you can see, a fairly sizable amount, but they also ranged in terms of what to look for. So across the board, it wasn't just prices, it was also about mortgages and what to expect in demand, and even RESAS, a great organization in the US and in Canada that the Real Estate Wealth Lab is happy to be working with. Their real estate technology is required, it was in caps, to do real estate business and will further evolve. So we want to make sure that we're following also the property technology trends, otherwise known as PropTech. Okay, so that was your macro and micro news, and I hope that was good for you. Pop it in the chat.
Jennifer, before I'm going to give your voice a break for just 30 seconds here, so you can grab a drink. Folks, you do not get, I've been in the investing game for a long time. You do not get this level of wisdom and intelligence by reading a newspaper or watching a show. I'm just so grateful for the amount of content that you're putting out, Jennifer. And it's not just the data, it's how to understand the data. I immigrated to Canada when I was about 18 years old, and I remember becoming a Canadian citizen. I had to go in front of a judge, and I thought that I had to know everything about Canadian history. He just asked me whether I liked the Toronto Maple Leafs. I said yes, and I was in. But, when things happen in other countries that are upsetting, and there is a pressure not only from us for immigration, for us to increase our immigration capacity. There's pressure from outside countries of people wanting to immigrate to Canada because we are a safe nation, because we have the rule of law, because we have jobs and opportunities and growth. Whenever there is pressure or disturbance in the world, people and money looks for stability. Some of the things, Jennifer, that you spoke about, like from even touching on the philosophical and the feeling oriented, how we respond with birth rates, with the change in the mandate for banking, all these things is causing a lot of upset in the emotional psyche of normal people. That means a couple things. One, we need to show up as investors who really know our stuff and are able to see through what's going on, because if we feel the winds of these changes buffeting us, think about how your tenants and your clients and your joint venture partners are feeling. So it is on us to provide stability Secondly, as you're going through this, you're also going to notice that people are, they're on a little bit of a trigger, like they're very quick to all of a sudden get angry. Like emotions are riding up high. Our job as investors, as people that provide housing, and people as investors and joint venture partners, our job really is not just to understand the economics, but also to show up as people that provide stability. And that's something that when we do that, we start to not only make money for ourselves and our investors, but we start to really create and be a voice of change in the culture that brings stability. And that, I think, as a REWL member, is rockin' awesome.
You know, you couldn't have said it better, Niran, in terms of coming from our chief leadership officer, is that this really does allow you to show up as a leader, not only in your joint ventures and your real estate context, but also just having a different perspective on the world. And you can take it or not, but at least you've got a different way of looking at it and things to look at if you haven't considered them already. And that creates strong leadership.
And Jennifer, before we move on, there's a couple things I want to mention. If you are listening to us, hey, we would love all the support you can give us. So take a picture, put us on social media, and please tag us. Real Estate Wealth Lab, tag us, put us out there. That would mean so much to us, to me personally, and to Jennifer.
100%.
Secondly, as you're listening to us present and Jennifer present, I am certain that if you are like me, you're going to have 1,000,001 thoughts and questions and comments. So, take notes, but if there's a question, don't wait, throw it in the chat. We probably won't be able to get to that today, but it will so help us respond in a timely fashion to what's next. So just throw it in the chat for us.
Awesome.
I think
Go ahead.
Go ahead, Jennifer.
No, you finish up there.
I was just going to ask you this question. I think what I'm hearing from all the research that you're providing is that given that there is all of this confusion in the market, given that there is this stress and volatility or the experience of it, and given that everything is stretching out, we can look for opportunities to buy at this time. And when I see the Omicron virus and all these things happening, for me, it provides an opportunity for us to buy more real estate before the prices really start going up. Is that right, or am I incorrect on that?
Yes, that's correct. 100%.
Thank you.
Wonderful.
Let's go visit the US now.
All right. And I see some questions in here from Christian and from Nick. Nick, we did not touch on currency trends at the moment. We've got a lot to cover yet. So we're getting into the market analysis. And also when it comes to Christian, you were saying about the Bank of Canada chosen to remain on the inflation target model. Yes, they have chosen to remain on the inflation target model. However, this is different. This is about them changing their mandate to be expanded to other areas. I mean, of course, that can change at any moment, but this is about the Bank of Canada's mandate, not just their primary sort of target model at the moment, and expanding their roles and responsibilities, let's put it that way. So I hope we got those, and let's get into the US real estate. You guys asked for it, you guys wanted it, so here's your 5 tips to get started. And there are so many aspects to it. This book is fantastic. It's 273 pages. We can't get through it all tonight. We will be tackling it. Oh, by the way, 100 years of combined experience just on this team in investing in the US real estate. So there's a lot to unpack. We've got a lot for you. We are all, not all, I can't say that, but many of us are actively investing in the US, and we will be sharing much more with you in 2022. So here's to get started. So you can think about it over the holidays of what you need to do to start your US real estate investing. The first thing is it's the who. We're going to just go who, what, where, when, how. I mean, honestly, that's what you got to do. So who is you need to do your team assembly. And this is it's always important, but it's particularly important if you're considering international real estate and being somewhere, investing somewhere that maybe you're not currently located, a little bit afar. You've got to do much more in terms of your diligence and interviewing and asking for referrals and getting the right people on your team. But some of those folks, it's a little bit different. I mean, it's mostly the same as what we're seeing in Canada. Like, you've got to have a legal team and whatnot. But I want to highlight a couple that you might think about a little bit differently. So yes, you need your corporate structure. If you're going to do a corporation, or if you're going to have it in a corporation or not, you need your legal team and your accountants to have a conversation together and identify what's best for you for tax purposes. Is it personal? Is it in your personal names or not? And also where you're investing and what you're investing. We'll talk about that in a moment. But you may also find that if you're going to have a US corporation structure, you may need a Canadian holding company to do that. And there's so many different ways. You don't have to do it that way. You could have just a US company. What kind of company? Is it a C Corp? Is it not? What are the benefits? What does a C Corp actually require? You name it. So you need a really good legal team. And that includes maybe even a securities attorney. If you're going to be going into that, like, offering and into that next level of investing, so that you're above the line. You've got your memorandum of offering and your memorandum of understanding and all of these things set up. And then also potentially immigration. Do you want to be able to access your property? It doesn't necessarily mean that you're going to live in your property or going to be in the US, but it might be something that you consider. Is there a way that I can manage my properties and not be restricted? Because there is a restriction on Canadians going into the US every year, whether you're not supposed to go there for business unless you've got your visa. So you want to have it all kind of set up. So that's an immigration lawyer that you might want to contact and get answers, and also a real estate lawyer who's going to actually help you with your very specific transactions on acquiring or disposition of your assets. Accountants. I'm going to talk more about these guys. You want cross-border taxes, accountants, and you want a local accountant. Yep, that's 2 accountants. Finance, mortgage, bank, even as Nick was kind of mentioning earlier, a foreign exchange, a currency exchange, property management, maintenance, renovations and constructions, realtors. And you really want to get an A team. This is, it's so important because you're international and you may not be there. It's just even more important. So number 2 is, I'm going to just do a little dive onto your team, your accountants. Here are some pro tips. You definitely need 2, 100% cross-border, and you need a local at the county level. And the reason for this is because you need professional counsel on your federal and state and international. That's the cross-border. They can usually help with that. So I should say international and federal is more the cross-border, and then the local will help more with the state and the local, because counties, just like in Canada, there's property taxes that are at the municipal level. That's kind of the same concept of city or county level, where those taxes come into play. And just like in Canada, counties and cities can apply and change taxes at any time. And in fact, they can be pretty disruptive, just like in Canada. So you need to have somebody, your cross-border accountant isn't going to be that expert. So just be forewarned. And then here is a pro tip. If you have not heard of Form 5472, write this down. It is the most, okay, I can't say that. It is one of the most important forms. And it's not a big deal. It just has to be submitted that says basically a foreign ownership of properties. There you are. And if you do not submit it, the fine is $10,000 a month per company, per property, however it's all set up. It just depends. So if you're dealing with property in the US, particularly if it's in a corporation, but I think it has to be otherwise, that you want to have that Form 5472 submitted and on time. All right, that's your pro tip. Number 3, what kind of real estate? This is what you need to consider really, really significantly. How hands-on do you want to be? How hands-off do you want to be? And there's so many different ways to be in international real estate as well as local real estate, where you might want to have a little breather and go, you know what, I really want to diversify my portfolio for all of the benefits that we mentioned at our last research lab in terms of benefiting from different politics and geography, and even, for example, natural disasters, where you might get hurricanes in one place and typhoons in another, or snow in another, floods in another, all those kinds of things. That's important to de-risking our portfolios, as well as currency, that kind of thing. So you want to be hands-on. You're going to be looking at more do-it-yourself kind of things, and you're going to be looking at different requirements from your A team, if you will. And if you're going to be doing it more hands-off, then that's cool. There's REITs and funds, and you name it, all kinds of different ways of doing it. So the question, and including like vacation homes, I've had plenty of people come up to me and ask me, I really want a vacation home, but I want to be able to rent it out and have it make money while I'm not using it. It's a very common way of doing it. So it's kind of do it yourself, but you may want to have a hands-off version of that. And the reason being is because there's a lot to know behind the scenes if you're going to be doing that. Short-term rentals, what's going on, extra taxes, what are the zoning and the bylaws, and you name it. So there's lots to just consider. And that's with anything, multifamily, commercial, industrial, single family. There's always changing landscape, and you need to have some expertise in that area in order to do it. So ultimately, take a breather and go, what do you want? And once you identify what you want, then you can get into the next question of where. And my simple recommendation at this point is to apply, I'm calling it homework because I think it's cute, but diligence in some ways is you want to do your macro, you want to do your micro analysis. And the Real Estate Wealth Lab provides our research labs where we do a lot of this for you as well. And the leading indicators, the lagging indicators, and then remembers which ones are leading and lagging based on what outcome we're looking at. So it's pretty cool. Lots to look at. Politics and policies. And that's very important. When we actually look at Florida next, we're going to see some politics and policies at play pretty significantly there that are actually pretty major buy signals. So pay attention, and we'll be there soon. Complete your homework. REWL, we're going to have a REWL checklist that's coming soon for sure. And with property analysis, you'll also want to do that at the next level, and that is your real estate. Oh, I don't know where my camera went. There we are. I went fuzzy. The Real Estate Wealth Lab calculators are incredible, and they work across the borders in US and in Canada. So again, checking in with your desires. What do you want your property for in the US? Do you want it as usage? Do you want it to diversify your portfolio? Do you want it as both? Do you want those palm trees and the dollar bills? Or do you just want a return on investment that you don't have to touch ever? All kinds of options, but those are going to help you identify which markets you're going to look at, because you can find some fantastic, opportunities with growth, for example, maybe in Boise, Idaho, which is great, but that is not a palm tree. Now, that said, Boise, Idaho has a fantastic French fry company. And if you like fries like I do, that might be just what you need. So you never know. And then when it comes to, again, these are just practical, your 5 top tips to get started in investing in real estate is I want you to consider finance next. So number 5 is finance. You will want to consider a mortgage broker, a currency exchange service, one that you trust and that gives good rates, because if you need to be transferring money across the border, it's quite helpful. And you need a banker. Setting up banking is not as easy as you think. As you probably know, just even in Canada, there's always signature and all the things that go along with it. And you really need to find a bank and a banker that will suit your needs and suit where your properties are. There's the big banks, but then there's credit unions, and there's some places that don't have all of those banks. So if you're going to be across the US, you need to consider what that looks like. And a couple other things to just keep in mind when you're considering investing in the US is that loan to value ratios are not the same in Canada. They're not the same in the US for Canadians. So whether you've got it in a corporation, the property in a corporation, or whether you're buying it personally will also affect that significantly. And of course, just like in Canada, it's your qualification, your income, like they do all the same things from that perspective, but it can be more challenging for a Canadian to get that financing. And so Whether it's challenging or you just get less of it is really the question. So we can get somewhere, it ranges from 50 to a normal sort of 80% loan to value. And another thing to consider is not all properties qualify for mortgages. And that's the same in Canada. Like, not every property is gonna get the bank to endorse it and say, yeah, that's what I like. For example, in really, really small communities, it can be very difficult for getting that mortgage financing because banks don't necessarily love them. And they change their minds just like everything else. So you got to stick with us all the time. But an example is a condo hotel, for example, like a vacation rental condo hotel. If there's no kitchen, there ain't no mortgage. So that's something like, okay, where are you going to get your financing from? Depending again on the type of property that you're looking for. So what's next is that REWL is going to be unpacking the whole process for you throughout 2022. What you need to know, it's a similar process to Canada. You need to assemble your team. You need to understand that accounting is very different and very important to have more than one accountant. And then just stick with us for the market research. When you know what your market is, you can plunk it into the REWL calculators and you'll be well on your way. So hang out with us. There's going to be more coming. All right. So we are going to, just looking in here. Nope, I'm going to keep on moving along here. Thank you very much for your chats and stuff, and the whole team can weigh in on questions in there, so I appreciate that. Market analysis. Now this is where we get far deeper. Yeah, this is where we get far deeper in our analysis in Miami. All right, GDP. This is, I'm going to blow through these really quickly because I want to be respectful of everyone's time. And I know we decided to do 3 cities plus the top 5 ways to invest in real estate and things you need to consider, but I really wanted to make sure that you had all you needed in order to start having your US real estate dreams come true. So we kind of are doing a deep dive, 3 friggin' cities, but here you go. So what I want you to know is that all of this data is available to you in your member portal. So you can come back, you can get the slides, you can get the images, you can get the graphs, and you're going to be good to go. All right, but let's sink into this, shall we? So Governor says Floridians know he won't let anybody lock them down. Now, this is not about politics of, listen, I don't care what your decisions are when it comes to the COVID-19 pandemic, when it comes to vaccinations or not vaccinations. That is not where this conversation is going. However, what it is going is what is affecting the economy, what is affecting migration, what is affecting tourism, what is affecting your rents and your real estate. That's the conversation we're in. So if anything sort of lands with you a little bit funky, I want to let you know that that's the place that it's coming from. It's to protect your real estate, your asset, your wealth, your financial freedom, and your financial future. So that's all I have to say about that as a little caveat and context. So the governor of Florida says, quote, "We will not let anyone take their jobs, ruin their businesses, close their schools, so people are going to be able to live their life. They're going to be able to make their own decisions." And this is where politics and policies can make a very, very significant difference in the locations in which we choose to invest. And in this case, and we'll go through a lot of the details in just a moment, this is a pretty significant, this statement and this position and this political stance is a very significant buy signal. Now, why the Sun Belt keeps growing? There are a lot of reasons, but you guys have heard of the Great Migration. We've talked about it. You've heard of the mass resignation and the Great Reshuffle, which is a lot of individuals moving to the Sun Belt. And the Sun Belt includes Florida, right down there. And and also because of affordability, there's a lot more affordability down south and in Arizona and Texas and Florida and whatnot. And I want you to just consider for a moment that there is a different, and this doesn't exist anywhere else. So you're hearing it first for the first time at the Real Estate Wealth Lab today, is refuge. Now, whether it's a place of refuge, whether it's the Great Refuge, but I certainly know, and I know many people actually even on this call today who are coming in from all sorts of different places like Mexico and New York and other locations, that there's individuals who have recognized that there's a different way of being out there in the world currently, and are seeking, not necessarily, I just don't want you to think about refuge like this picture down here at the bottom, but that is happening in some cases in the world, and we just need to be mindful of it. So as we look at all these other amazing factors in economics and jobs and whatnot, Florida is going to stand out among all of the other states in America because of its politics and policies, because it is also a place of refuge, because it is not discriminating, and because it's got lots of job opportunities, and it's got palm trees. So, hey, it's part of the Sun Belt, and palm trees are definitely winning too, and that affordability. So this slide, I think, is probably very helpful for individuals to really wrap their heads around Florida as a state. So hopefully that helps you. And particularly now, Florida as a state. Now, I mentioned earlier that we were looking at some cool data, local versus remote buying, and how it compares in 20 cities. And so this is where we're seeing the trend of property tech, prop tech coming to the fore. And this identifies 20 metros with the most the most non-owner occupied properties. In other words, where individuals, remote investors like yourself, if you're Canadian and thinking about these markets, you would be a remote investor and buying it, and where people like ourselves might be purchasing. And what that means is that okay, I'm not going to go through the top 20, but I'm going to share with you which ones were called and which ones we're actually looking at today, because the competition. So these markets are going to be attracting, by the way, the actual article for this that lists all 20 is in your newsletter for today. So if you are a member, trial member right now, and maybe Paige, you can pop that in the chat. If you are a member on this trial membership right now, you will be gaining access to that article, and you'll see the full 20 because those might appeal to you as well. So I think it's realestatewealthlab.com/trial. So hope to see you there. So then virtually, prop tech, virtual buying, that's on the rise. And Vincent, I think you're writing in there, oh yes, exactly, you've got all of that. But also the Real Estate Wealth Lab just released QR codes. Now, I am not the technological person, but I know that I've actually started using QR codes, and they're pretty darn fun. So now imagine that with your real estate and virtual property, looking at virtual properties and buying them and doing lots of things. It makes it far quicker. So really watch for announcements from our technology team, Vincent, Ken, the whole team behind the team, lots of other individuals, which is super cool. And the data supports rules of market analysis selection, pardon me. So it was interesting because we had already selected the top these three key markets to consider in Florida. And then this article just came out. So I thought it was great validation of the data, of what we're looking at, and why we would even consider analyzing this. So them and REWL all chose Orlando, Miami, Fort Lauderdale. So there you are. And those are the three markets that we're looking at tonight. So I think that that's a great, again, validation of why we're here to understand these markets. So I'm going to get into, as always, we start with our economic health, our GDP. And as I mentioned to you earlier, we want to look at that net GDP. And so there is a bit of a gap. So the United States forecasts real GDP 5.7%. Florida, 2020, minus 2.8. So all things considered in 2020, by comparison, Canada, I think, was somewhere around, what was it, -7, I think, in the end. So it didn't get as affected. And again, politics and policies were kind of similar to support not having such an economic demand. So 2021, that's this year, a growth of 5.4. So if we look at the gap, that's a 2.9% net positive. Do you know, I haven't seen that hardly anywhere. So that is freaking awesome. Like, it's really, like, to have the net, like, that is good news. I'm still being very conservative, and you'll see that the arrows here, none of them are like this or anything like that, but this is definitely good news for Florida. And when you look at Miami's GDP and economic health, just by the way, I apologize, but I've never really used a lot of GIFs, but for some reason I felt that it was the holiday season and GIFs were just like resonating with me. And so we've got GIFs here today. So this is not bad GDP growth. We've got for 2021 for Miami a 5.4%, with meaning a net real GDP growth for 2021 of 2.7%. Remember earlier when I was talking about GDP and I said like 2-3% is good GDP growth, like that's sustainable. That's a great long-term buy and hold. Nothing crazy. That's good. All right, Miami. All right. So we're happy about that. Is that Ryan Reynolds? Yeah, okay, cool. So Ryan Reynolds agrees. All right. So Miami grows as global tourism destination. So it actually is in the top 3 destinations in America. And why do we care about tourism? Well, tourism is a huge economic impact. It definitely helps, but especially at these times. So what we're noticing during the pandemic, and as I mentioned earlier, is that not only Miami, but so Florida, but Miami is becoming more and more of a place for individuals to go. They've increased their transportation routes, their tourist arrivals numbers have increased, and they are topping pre-pandemic levels in recent months. And again, it's because they're open for business, because of the politics and policies, and people are going there. I know of some great folks from Edmonton who and they've got 3 kids, I think, 3 kids, and they just went down, you know what? I'm out. I'm going for 4 months, packed up the family, Airbnb'd the house in Edmonton, and are heading to the Sunbelt themselves. This is to get away from the restrictions and to stay inside. So there you are. So it's real. It's having a real impact on migration and on population. So when we look at Florida's tourist arrivals, they're on the rebound. Again, I won't spend too much time on this. I just want to make sure that you have the data in the background. So when we look at jobs, the labor market is making progress in Florida, but it's still impacted by the labor shortage. What we are seeing though is that wages are accelerating for 6 months. We're seeing that a little bit everywhere, is that wages are going up, which is a good thing, especially as inflation is going up, and they're not going up as much as inflation. So we're still not seeing the affordability materially impacted, but at least there's some movement, and employers are increasing wages to attract more workers. So that's a good news story as well. And this is largely the same, but what I want to point out here is that when you look at the unemployment rate, it's like with Miami down 3.7 or at 3.7%, lower than the state, lower than the nation. That's good news. But unfortunately, in the weird circumstances that we are in right now, lower unemployment figures aren't always a positive sign, because we're going back to people exiting the workforce, the forced resignations, the great migration, the reshuffle. So we don't really honestly have nobody has a really great picture of what is happening in the employment market just yet. It's still too early. And that's why we're looking at data from LinkedIn to see, okay, I'm leaving this job. Where are they coming back up and resurfacing on LinkedIn to see where they're getting those jobs? So, but all things considered, this is good, pretty decent. It's improving, it's okay. We're seeing that labor force being a slightly increased, positive sign of recovering labor market. So that's there. And then moving along to people. And what we're seeing with people in Miami is actually, it's a little bit less growth rate than what we would have liked. So we're seeing tourism up there, but we're not seeing it hit where Florida is compared to annual growth rate, or even the US, it's at a negative. So people are moving out of Miami. Not too worried about that. We need to do some homework on it and understand more of those like migration patterns. I suspect that most of that is because of affordability, and that there's lots of other really cool areas that are being revitalized. Like there's even new surf locations in Florida that are now all of a sudden on the map. Never heard of them before, and now they're attracting the surfers. So there's all these like really cool communities that are not even just being revitalized, but they're almost being created, and that's attracting some individuals. from Miami proper. But we are still seeing Sunbelt reshuffle, refuge, you name it. And so there's more migration coming. I think it's just early, but I would watch this. I wouldn't, yeah, just be careful of watching that guy. It's too early. What is this? The resident population, pandemic-related flatlining of population. Again, I believe that this trend should reverse, especially with the governor's political stance on and policy stance on the imposed government restrictions due to the COVID-19 variants and whatnot, and the pandemic, that there's going to be opening of borders, migration trends, and more. So I'm very hopeful on the population. With the rental market, Florida residents are seeing the highest rent increases in the nation. So Florida saw a 29% increase. Now that's an indication of a lot of things, that people are moving in, that there is the economic activity, which we've seen, you know, it is there. So that's for Florida. And then as we get into Miami, specifically with regard to the Miami rents, 1-bedroom rent is up 35.6%. So I'm just gonna go back. So when it comes to Florida, is up at the state level, 29%, Miami up 35.6%. So we wanna look for those factors and those indicators being higher than either the state or the nation. And so in this case, Miami's right on. So it's the highest increase in the US in November, and it is in the top 7 most expensive rental markets. So now this is something that so rent and property markets are lagging indicators. So it's not necessarily that we have to be like really, really watching these closely, because these are based off of previous data, but it's a little bit different. And I think the next slide will help us identify that. It's a little bit different because, and that's why our real estate cycle formula is so important, because it looks at these independently. In a way that's never been looked at before, these leading indicators, because they're not all created equal all of the time. And this is where population is truly a phenomenon. I mean, you guys remember I was talking about lying flat, and the Great Resignation. What's happening is individuals are going, hey, all right, I'm going to go to that surf location. I'm going to go to that, and I'm going to have a really great life and figure it out. So we're looking at a real different demographic behavior. We're looking at population trends differently and how they're impacting us. So when we look at, and this is where I want to show you, is that despite not having like a super, I mean, it's a good economy. The GDP growth for Miami is good, for sure, by comparison, but the jobs not looking so great. Population, you know, like it's just okay. But these rents are going up month over month, as well as year over year. And when we look at rents, we want to look at month over month in particular, which that helps us identify what trends are happening right now. So this is all very good sign. And it means that that population lever is being more impactful than ever before. And that's great. We're watching it and we're onto it. So when it comes to the real estate market, buying activity is up. Again, these are all, thanks Vincent for popping it in there. These are all going to be in your member portal because we can't go through all of these stats, but they're there for you. So buying activity is up, inventory is down, and that means that residential sales are down 12.4% year over year, but the prices have gone up 12.6%. So normally that's kind of an interesting, sales are down, and yes, prices are up. And why is because lower supply, lower inventory does not necessarily mean that there's a decline in demand. It simply means that there's a decline in individuals wanting to sell. And in fact, demand may be higher, and that's good for the prices. Although if we're trying to buy, we got to be mindful and get in there quick so that they don't go up too much more. And when we comes, there we are, get in focus. Miami condos and townhouses. Look at these numbers. These are right on cue. Forecasted in Q3 2021 that condos and townhouses in major cities, New York, Vancouver, Toronto, Miami, you name it, would have a big resurgence. And they are literally right on track. This is October data. I was expecting it in September, and here we are. Major sales are up 28%. Median price is up 22% year over year, and the inventory is down. There's just not enough to keep up with the demand. This is the Malenzies, people. They're coming in to those downtown cores, and especially in areas where the politics and policies are supportive of opening. There was a question, yes, Julius, I think, who is it? Yeah, somebody earlier, sorry, pardon me, mentioned that they're in Jacksonville. So this is for you, as many others, is that the Jacksonville area home prices are also expected to climb. And again, this is really, when it comes to Florida, the key cities are the ones that are near the water. So just keep that in mind. And where retirees go is also a really good place to consider, and surfers. So what we're seeing is that the trend, and this is is a quote, the trend of inventory shortages continues and will go with us into 2022. And we've got active inventory down, not only from this time last year, but also last month. So again, we're just nothing staying on the shelves, if you will. And that is good news for a market. Now, I've got 2 more markets to go through. Stick with us. This is pretty cool. These 2 should go through pretty quickly because they're quite similar. And that's why I put this little slide here. Fort Lauderdale is a 1-hour drive from Miami. 1 hour. So as you can appreciate, it's very, very similar. It's very close. It's got a different and unique aspect to it insofar as it's actually a place where a lot of Canadian snowbirds go. I've been to both, and Fort Lauderdale, there's a lot of Canadians hanging out there. So we definitely want to keep that in mind. So I'm going to go through it really quickly because it's close and similar to Miami with a couple of nuances. So similarly, Fort Lauderdale was considered a vacation-only destination, snowbirds for you name it, but it's actually thriving and becoming this attraction of actual high-profile businesses and emerging talent pool with significant investment and infrastructure. Did you know that Fort Lauderdale has its own airport, even though it's, look at that, an hour drive from Miami, and it has its own airport? These kinds of infrastructure components are very, very important. So when it comes to the GDP, it's similar to Miami, which is, like I said, not bad. We don't have figures available for the current GDP growth and the net real GDP growth. So we would take, what one would do is do proxy data and come up with an essential, I got that, but for now, but we've got a way to get that and extract it from all these other indicators. So we're good, don't worry about it. But at the moment, for where we are for this market analysis, is that it'll be quite similar to Miami's. And we're also thinking, okay, so some folks from Miami are going to actually be moving out. We have a ripple effect. They move out of the downtown cores and they go to where growth is coming and burgeoning and affordability. And Fort Lauderdale meets all of those criteria. So I'm thinking it's not bad. And it's not just a thought. There's stuff behind there. All right. And then similarly, again, like their unemployment rate, November 2020, November 2021, it's improving. We do want to be mindful of it not being necessarily a positive sign because of all of the reshuffles and resignations and whatnot. So something to consider, but it is definitely improvement. And their labor force actually increased 1,000 people, which is definitely a positive sign of a recovering labor force. So that's very good news. Unemployment rate, like I said, that's a graph for you. So when it comes to people though, all right, lower than the statewide and national average, but a little bit higher than Miami's. Remember, Miami was a negative 5.5, and this is at a positive. So we need to keep that. Fort Lauderdale's population is on the rise. When it comes to the rental market, similarly, 1-bedroom rents are up 12.9%, and it's now the 10th most expensive rental market in the US. Wow. Wow. So another good sign is that Fort Lauderdale rents are up month over month and year over year. Such a good sign. Now, again, this is for that long, slow expansionary phases. You got it. It's this is a modest, we're not looking at huge, like if you want to play the stock market and be speculative, that's not what we're talking about right now by that in real estate. So the real estate market, the housing supply is down. The median home prices are up 23.7%. So that's all up, and that's good. With when it comes to the condo market and the townhouse market, like Miami, it's a core center. It's got its own airport. It's got things going on, and the median price is also up 10.26% year over year. So market analysis for Orlando. Now, that's a 4-hour drive from Miami, so 3 hours from Fort Lauderdale. What do we know about Orlando? Disney World and the Kennedy Space Center and all these other incredible tourist attractions. So we've got to be paying a different level of attention to what's driving their economy. So when you look at Orlando's GDP, it was down 4%. Well, of course, these attractions were closed during the pandemic, so that's definitely going to have a more material impact. So their net real GDP growth from where they were to what we've seen as 2%, it's still negative. They haven't had the opening. Now things are changing, but they haven't had the openings that they need to fully recover. So the net real GDP growth, it was so. Let's watch that for the future and what's coming down the pipeline for sure for 2023. And so what we want it to do is we'll likely see it stabilize to 2% growth towards 2023. With these openings and with this politics and policies and with this particular governor operating the way he is, and Disney World being open and the Kennedy Space Center opening, things like this, these types of attractions that are a major draw for the tourism activity that impacts GDP, that's going to be significant growth. So we'll be wanting to watch that quite closely. And again, for their unemployment rate, November 2020 to 2021, it's decreasing, so that's good, but we're just managing that workforce, what's actually happening. It's still a little too early. We've got to do a little bit more exploration. The unemployment rate is, again, it's improving, so that's good. Are you ready for it? This is where it gets very interesting in Orlando, and a little bit of a kind of a cool one. I'm excited. All right. Wow. The population growth in Orlando. Remember, Miami was negative 0.5. Fort Lauderdale was 0.13, I think. This is 1.19%. The United States was 0.4. Florida, 0.28. This is massive migration. Catherine Copeland. Well, thank you. You just said Disney just relocated 2,000 employees and their families from California to Florida. Well, there you go. This is happening. People are moving to Florida for all kinds of different reasons. And this is where we start to look at the weighted lever of population over and above economics, because economics normally will drive jobs, which would drive population. But the reverse can happen too. The population can move and then create the jobs and the economic activity that further pushes our rents and property prices. So I love our model. I love our formula. I love how we're looking at real estate. This is really, really sophisticated and the way to go forward. So Orlando, 23.7% growth rate in the last decade. It's eclipsing other areas, and Jacksonville was the closest at 18%. So again, we're looking at population growth a little bit differently than we may have otherwise considered. Just a couple more here. We want to go through the population. Those are some details about it. It outpaces. Orlando's rocking it on the metrics for the population. And then its rental market, similar story. It's up month over month. It's up year over year. All of those are good. It's high up there. And then the rental, just the real estate market. We've got that the housing supply is down, same story. See, what I love about doing these market analysis, when you start at the state and then you go through a couple of cities that are close to each other, you can kind of blow through this really quickly because you can see those trends and you can see, okay, so this is, and what's important to me as an investor? Is it the population growth or is it the economic activity? Whatever that is, you can start to really compare. And that's what a lot of our REWL members have asked for, is how do we compare properties? How do we compare them? And this is one of those ways that you get to do that live, real time with all of us. So again, they're up 20%, record high. Months of supply is also down, just like everywhere else. So that's going to be good. It means all of these things together, when we look at our conclusions for Florida, for Miami, for Fort Lauderdale, and for Orlando, is that the macro indicators are that the macro at the national, as well as particularly the macro at the state level in this case, are big influencers impacting all of the indicators right now. And that is all going to affect Florida real estate. We need to spend some more time on this in terms of your attention is required. The governor's stance on the government restriction imposed by the COVID-19 pandemic elsewhere, he's not doing it. And that means that they're open for business. And that means that Florida real estate is going to do better than other states. Full stop. So the Florida indicators, again, as I mentioned, there's a huge, incredible opportunity. There's an opportunity for real estate investing, and watch for outpacing or leading growth because of the factors that I mentioned here today. And our overall conclusions, one more thing, is that in US and Canada, we are going to be experiencing a long-term modest housing price stabilization and expansion period over the course of this decade. There will be a couple of dips, and I've already got them in my mind as to when they are. Again, watch out for 2023 and 2024. More to come. Got a little time. But for a long-term buy and hold, this is something that we are very clear on. Biggest issues are the economic recovery amid the COVID-19 government restrictions, inflation, and interest rates. So that's why we're spending a lot of time on that. And that one big caveat, the pandemic. And so I'm going to leave you today with these two resources. Actually, well, we've got a little holiday, little something there, but I want you to consider something fun, some satire. This is some of the best satire that I have seen in a long time. There's a lot of heavy news out there, especially when it comes to the pandemic and things. And there's a lot of division in this world. And if you're going into the holiday season, and whether you're able to see your family or potentially you're unable to see your family due to some of the restrictions that are being imposed, this may be a way to help break the ice or to share with individuals so that you're not having to necessarily communicate your perspective. And somebody who's a comedian could potentially communicate your perspective, or if it's not your perspective, then you get to see what other people's perspectives are. So it's very interesting. It's a 2-part series. You might laugh. You will definitely not. Well, you could cry at the absurdity of it. It's really fun, and so I highly recommend checking out JP Sears Part 1, the Life Jacket series, and Part 2, just to give yourself a refreshing laugh at what is happening and why Florida and its politics and policies are even more important than ever before, because we are in absolutely unprecedented times. So I hope you enjoy these as much as I did and my family, and it's been a great way for us to communicate differently with ourselves and with different opinions. So ladies and gentlemen, that was your real-time data, real-time analysis, real-time insight, next level intelligence, and thank you so much. Please follow us on Instagram at Real Estate Wealth Lab. Please join us for our incredible suite of all of the products that we're offering: weekly reports, expert commentary, macro market trends, market analysis at the city level, digital events, you name it, masterminds, you've got it. And this free trial is actually over in 9 days. And Niran, we'd like to wish everybody a happy holidays.
We absolutely would. But before we get there, folks, you've been listening to this, and we are just getting the aircraft on the runway right now. So all the information you've been getting, if you have found this of value, throw it in the chat. Give Jennifer some love, give her some kudos and thank you, because that's a lot of work that Jennifer, you have pulled together. So buckle up. For those of you who have joined even while we were on the call as REWL members, welcome. And if you are, you know what, just come join our family, because we are going places and we're committed to your success. We're committed to our own success. We're all investors. Let's go. And now, Jennifer, you got a hat on. You know what?
I did. While you were talking, and I see Paige has put on her little antlers there. Jens
there we
here. Go. There we are. So just from us, all of us, and not everyone is available at the moment, from the REWL team, that we would like to just say again, huge thank you, huge appreciation for all of your support. We're only 2.5, I guess we're still 2.5 months old, almost 3, and just wait until we're crawling and we are off to the races, and we're so delighted for you guys to be here. So Merry Christmas.
Merry Christmas, everybody.